Could your old 401k be a massive hidden tax trap? Welcome to this explainer. If you've recently changed jobs or maybe you're stepping into retirement, that money sitting in your previous employer's plan might literally be a ticking time bomb if you don't handle it exactly right. But do it right and you unlock serious tax-free financial growth.
So, here's the big question. Could moving your 401k actually cost you 20% in upfront taxes? Well, yes, absolutely. If you move a 401k the wrong way, you trigger these massive mandatory tax withholdings, plus potential penalties from the IRS. It's this brutal mistake that catches countless people completely off guard every single year, taking a huge, unnecessary bite out of the wealth you've worked so incredibly hard to build.
Just look at that number, 20%. That is the mandatory federal tax withholding the IRS demands if you accidentally act as the middleman for your own retirement money. Imagine that! Losing a fifth of your savings right off the top just because of a procedural error? No way! We're going to make absolutely sure that doesn't happen to you today. Okay, let's dive into this. Here is our roadmap to navigate this safely. We'll start with the tax-free rollover, then compare direct versus indirect rollovers, talk about choosing the right account, go through your step-by-step guide, and finally wrap up with common mistakes to avoid.
All right, part 1, the tax-free rollover.
Look, the ultimate goal here is simple. Keep your retirement savings completely intact and growing without giving the IRS an early cut. So what exactly is a 401k rollover? Basically, it's just moving funds from a previous employer's retirement plan into an eligible personal account, like an IRA, while maintaining its tax-deferred status. When you leave a job, a rollover lets you consolidate your accounts. That way, your money continues growing without triggering an immediate taxable event, assuming you follow the rules, of course.
Which brings us to part 2, direct versus indirect rollovers. Now, I need you to pay super close attention here because the IRS rules on how this money physically moves are incredibly strict. On the left, we've got the direct rollover. This is a trustee-to-trustee transfer. The money goes straight from your old plan to your new account. Because the funds literally never touch your hands, there is zero mandatory tax withholding. It's the hands-off, totally safe approach. On the right, though, is the indirect rollover. This is the middleman approach, where the old plan makes the check payable directly to you. And let me tell you, the IRS makes a terrible business partner when you act as the middleman. The second you do this, they mandate a 20% tax withholding. Ouch! And this brilliantly illustrates the terrifying math of that indirect route. Let's say you have a $20,000 distribution. The plan administrator automatically withholds 20%. That's $4,000 gone. You only get a check for $16,000. But here's the absolute kicker. To complete the rollover tax-free, the IRS still requires you to deposit the full $20,000 into your new account, which means you are forced to find $4,000 out of your own pocket just to complete the transfer. Sure, you eventually get that $4,000 back as a tax credit when you file your return, but until then, you're totally on the hook.
And it builds into an even bigger stressor, the number 60. If you choose that indirect method, you are put on a literal ticking clock. The IRS gives you exactly 60 days from the day you receive the funds to deposit the entire gross amount into a new eligible retirement account. No exceptions. If you miss that 60-day deadline, the consequences are brutal. The transfer is instantly treated as a taxable distribution. Boom. That means the entire amount is added to your taxable income for the year. And it gets worse. If you're under 59.5, you're going to be slapped with an extra 10% early withdrawal penalty on top of that. Failing to redeposit the full amount on time completely ruins your tax advantage status.
Moving on to part 3, choosing the right account. To guarantee a penalty-free transfer, picking the right destination is step 1. You generally have two main options for your new account, a traditional IRA or a Roth IRA. A traditional IRA is for pre-tax contributions, so if you've got standard pre-tax money in your old 401k, it should go straight into a traditional IRA. This keeps the money tax-deferred and avoids any taxable events. A Roth IRA, on the other hand, is for post-tax contributions and gives you tax-free withdrawals in retirement. If you made after-tax or Roth contributions to your 401k, those pair perfectly with a Roth IRA. The golden rule here, match your rollover to your original contribution type.
All right, part 4, your step-by-step guide.
So if the whole indirect rollover thing sounded stressful, don't sweat it. Here is a foolproof step-by-step action plan to execute this safely. Step 1, open the new receiving IRA account first. You need that new account number and routing details completely ready to go before you move a single dime.
Step 2, request a direct rollover from your old plan administrator. Be explicit. Tell them you want a trustee-to-trustee transfer. Step 3, instruct them to make the check payable FBOU.
Let's pause and talk about what that actually means, because it is absolutely crucial. FBO stands for the benefit of. This is the magic phrase used on rollover checks. By having the check made out to the new financial institution, FBO, your name, like Vanguard FBO John Doe, it proves to the IRS that the money is just transferring between institutions. It proves it's not being cashed out by you. That tiny little acronym, that is your ultimate shield against the 20% withholding tax.
Almost at the finish line. Part 5. Common mistakes to avoid.
So the crucial point is, even with a perfect transfer, there are a few final pitfalls you really need to dodge at tax time. First, don't mix up your terminology. Make sure you specifically ask for a direct rollover. Second, and we mentioned this earlier, moving pre-tax 401k funds directly to a Roth IRA will trigger a massive taxable event. Match those account types. Third, and this trips up so many people, forgetting to report the rollover on your tax return. Look, even though a direct rollover isn't taxable, it's still a reportable event. The IRS needs to know it happened. Which leads right into the last point. Never, ever ignore the 1099-R tax form sent by your old plan. You've got to use the info on that form to properly report the non-taxable rollover on your Form 1040.
To wrap up everything we've covered today, just remember this one core takeaway. Direct rollovers are the safest, most stress-free highway to protect your retirement wealth from unnecessary taxes. Always, always let the financial institutions pass the money directly between themselves so you never have to play the risky, expensive role of the middleman.
And of course, I have to state clearly that while this explainer provides valuable information based on IRS rules, you should definitely consult with a financial advisor for personalized advice tailored to your specific situation. Everyone's financial picture is totally unique, right? I want to leave you with one final thought. Is your old 401k just sitting idle, maybe hidden in a forgotten account somewhere? Or are you ready to actually take control of your financial future today? By using a direct rollover, you have the power to consolidate your wealth safely and keep it working hard for you. Thanks for joining me on this explainer, and I'll catch you next time.